What's Making Headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hi there, welcome back to What's Making Headlines. It's Annie, Will and Ben wrapping up the week for you with what we've been writing about here on The Advisor, what we've been seeing, what we've been doing. Been a pretty busy week for news this week. Lots going on that we've been writing about and talking about and interviewing people about. But one of the things that's sort of been, I think, a common theme that we've started to see emerge is the amount of brokers currently on TV. There's a lot of adverts out there at the moment with people who are genuine, real brokers actually appearing in adverts at the moment. We've got a huge amount of media campaigns and millions of dollars being spent by some of the major brokerages in particular. This week, for example, we saw Mortgage Choice launch some new adverts. Loan Market has got some adverts out at the moment. Aussie's got some adverts out at the moment. You just turn around everywhere and people are talking about brokers. Very exciting to see some celebs on TV. What do you guys think about seeing people that you write about each and every day on the television, telebox?
Yeah, I think it's good. It's good probably rather than paying actors to pose as brokers. Probably good to get the real brokers in. And it makes sense too because they're the people the clients will be dealing with. So yeah, I think it's good overall.
Yeah.
We were just saying how interesting it is how much Aussies love property and property on TV.
Yeah.
Getting experts on to talk about it's interesting when you think, I guess it's how many people kind of comes up in conversation and stuff. Culturally, it's a big part of the Australian culture.
Yeah, I remember when I first started writing about broking here on The Advisor, like almost 10 years ago, and people always would say as a sort of throwaway comment, they'd be like, oh, you know, when you're around the barbecue talking about your mortgage. And I was like, do people do that? Like, we don't do that in the UK.
Feels like a loose barbecue.
Yeah, and I was like, okay, but now it's like a common thing. I'm like, you know, when you're at a barbecue and you talk to someone about their mortgage, I'm like, why are people talking about their mortgages? Like, it's so weird. But here it's a big thing. And property shows, so the Mortgage Choice advert actually was on Sunday, I think, with The Block. The Loan Market advert, I think I've seen on Instagram. It's been served to me. I don't think that one includes actual brokers in that one. That's more about kind of people creating their own dream property and kind of making it their own. And then Aussie had an advert out recently as well. And I think that one, also I'm not sure if that one included brokers, but it had people kind of being like, an Aussie broker can help you save. There was something about quicksand. Do you remember that one?
Yeah, I've seen their adverts everywhere.
Yeah. And like, sort of on bus stops.
It's always on bus stops,
So the Aussie one also came out, I think maybe last month or a couple of months ago, and that's also, you're seeing Aussie brokers though on the House Hunters Australia show.
Yeah, that's it.
So seeing brokers everywhere at the moment, and I think it's really interesting to see this big push from the major brokerages in terms of spending quite a lot of money on these advertising campaigns. Mortgage Choice one, for example, has lots of brokers in it. It's quite cool to see them talking about what they're doing, but also has a big billboard by the airport. There's lots of billboards around down by here in Sydney, down by Barangaroo. And I think their campaign's called More. But yeah, so cool just to see some brokers and like, you know, turn on TV and be like, oh, I know that person. Yeah. So yeah, cool to see that. Outside of just watching TV and pointing out all the brokers, we have also been writing about what's been happening in the economy, in the property world, in the lending world. And one of the things that we wrote about, I think this week, Will, was your story around the PropTrack report that came out in partnership with CBA around first home buyers and what they're seeing in affordability. What were some of the key sort of takeaways for you?
Yeah, essentially new research on affordability for first-home buyers. Obviously, we spoke about loads last week with the first-home guarantee expansion. And some really interesting findings. So this is PropTrack and CommBank research. And they found that essentially for first-home buyers, renting and earning income on average 129 grand, that's the sort of baseline. They can only afford 70% of homes sold in the past year. 17, yeah. And that compares to 33% for existing owners with a mortgage. And essentially, so the research started in 1995. They found that affordability for first-time buyers has never been lower, which I guess we've kind of seen with a trend, but it's still kind of shocking to see it.
Lots of property prices going up really, really fast, much faster than incomes have. So, and then plus the supply problem, pushing that up further. Yeah. We did also see, I think last week again, CBA, was it CBA? One of the banks changed their price forecast. No, it was NAB, I think, actually.
Yeah, NAB.
So I think NAB had changed theirs. They had expected annual house price growth to be about 3.5%. They changed their forecast to be about 5%, I think it was, for this year. So now most of the majors saying they expect house price growth this year to be 5%. And of course, not many people's incomes are going up by 5% a year. So
I think 3 of the big 4 have lifted their forecast now.
Yeah.
Yeah.
I'll have to check.
It was interesting, the same data, obviously bad for affordability, but they actually found that first-time buyers more are buying than before the pandemic and substantially more than mid-2010s, even though it's that unaffordable. And they said part of it was to do with rent vesting, more people buying and then not actually living. And then just saving with a smaller deposit, things like the first-time guarantee scheme, brokers kind of helping buyers buy with a smaller deposit. So CommBank data, it was obviously everyone aims for 20, but I think it was 80% have less than 20% now, or maybe 85%, which is quite interesting.
Deposit, yeah.
Yes, deposit.
Well, you'll have to keep an eye out for the October edition of the magazine where we go into all of the solutions available to help people get into market without a 20% deposit. Ben, you'll be covering that one for us, I think in partnership with Deposit Power. But speaking of investors and more people looking at investing, we are also seeing some interesting data come out around that, and we'll get into that just after this message. So we did some analysis this week, and everyone listening, you're welcome, because this is not something you necessarily want to do, going through spreadsheets from APRA and the ABS, looking at what's happening at the bank books and what sort of trends we're seeing. But we do the hard work for you so we can kind of identify some of the trends and do some of that analysis. And one of the things that I took a look at this week was the monthly authorized deposit taking institution statistics. So basically, every month we see from APRA the volume of lending on the books of the regulated banks. And this sort of analysis that we undertook actually looked at, well, rather than just looking at whose book is growing, because we do that every month anyway, and obviously most of the time, most people's books are growing. That there are one or two exceptions. But this month I was looking at it and I was like, what's actually really interesting is looking at the pace of growth in the different types of lending. So investor books have grown annually faster than owner-occupier books. And that is the first time on record that has happened. So I was having a look at it and being like, well, what's sort of been the general trend here? So just to give you some headlines, if you didn't read this story already. So the annual pace of growth for investor mortgage books at the banks rose 6.1% year on year, whereas owner-occupiers only grew 5.6%. Now, that's obviously huge growth. And I think part of it is being led by the fact that first-time buyers and many buyers in Australia can't actually afford owner-occupier properties because of the lack of supply, because of house prices, because of income constraints and serviceability issues, of course. So they're looking at investing elsewhere. So just really interesting to see that for the first time since records began. Now, admittedly, records only began in 2019. So it's only really 6 years worth of data, but that's the first time we've seen annual investor growth higher than owner-occupier. This is to the year to July. But of course, that's coming from a lower base. So generally, investor books around 755 billion now at the banks, whereas owner-occupier is over a trillion. So seeing a lot of different moves. And again, the big bank that we keep talking about, and it's not paid promotion. They just keep on growing their book incredibly quickly. It's Macquarie Bank. So they are leading the charge. They had $1.5 billion of investor loans up in July. That was up 2.7% month on month. So really fast growth at Macquarie. And again, their owner-occupier book as well, growing very rapidly. But Macquarie actually grew their investor book faster than CBA did, which I think is incredible. So the CBA grew its book by 0.6% to just over 200 billion over the month of July. And of course, that has the largest investor book of all the banks. So just seeing this like real trend of investors coming into market. Ben, I know you wrote recently an investor feature for the magazine as well. I mean, what else are you sort of seeing in market that you think might be incentivizing people to look at investor lending?
I guess it's that sort of leverage if you're an experienced investor, sort of having that equity and being able to potentially acquire a property. But if you're trying to get your first property on the ladder, I suppose buying in that rent vesting approach where you sort of buy in an area that's more affordable and live somewhere else could be an attractive option. It's really interesting. We wrote about it in our September magazine, which should be on desks now, which was sponsored by ResiMac, and they're doing a huge amount of business with investors. So Yeah, it's been interesting to look at the story from this week and see that sort of reflected in the figures as well.
And we had also seen that, I think, in the figures from the ABS. We looked at the number of loans. Now, that's over the June quarter, but the number of loans for investors were also up something like 3.5% on the previous quarter. So we are seeing this ongoing trend of investor lending really coming to the forefront. And I think at the beginning of the year, a lot of people, when we were sort of doing our predictions for the year ahead, a lot of people were saying, this is the year of the investor. Lots of people coming into market. And we've talked to lots of brokers recently on the podcast about it as well. Eva Loissons from Finney, for example, she's an investor specialist, and she was saying so many of her clients just really kind of seeing it as a great time, a great opportunity, and maybe not even necessarily thinking of buying one property, but buying several, and kind of looking at their options with a broker to do that. But speaking of investors, there was also another story we wrote this week, which I thought was really interesting from Piker. Now, if you don't know Piker, it's basically an association that represents property investors. And they wrote to several associations this week, warning them about potential for unlicensed advice. Now, the chair of Piker, interestingly, is a broker, Ben Kingsley, who we know quite well down at Empower Wealth. And he wrote to mostly real estate associations, but also the broker associations, talking about the fact that he and the whole association was worried about people maybe stepping into offering unlicensed financial advice where they shouldn't be. So I think a lot of this stems from buyer's agents, really. So a lot of the focus was saying, it was quite a long letter that they sent. It was about 10 pages long. But the gist of it is basically saying they're seeing a lot of, particularly on social media, people positioning advice, which they're not licensed to do. So maybe it's about wealth creation, maybe it's about superannuation, but really specifically targeting property investors. And again, he was sort of saying this really coming from a lot of buyer's agents, but also potentially some brokers. So I'll give you some examples here. So they were worried about, accountants as well, those appearing to be harnessing speculative marketing, particularly on social media, opening themselves up to conflicted conduct and potentially unlicensed advice. So some of the issues that were particularly sort of focusing on what maybe they're seeing from brokers was firstly using unsubstantiated get-rich-quick messaging and tax-driven investment claims in their marketing. So they were saying basically people talking about on social posts like above average returns, using advantageous calculation methods and kind of not really having the right sums when it comes to what they're seeing on return on invested capital when it comes to property investment. Seeing also brokers potentially encouraging clients to buy a property through trusts or SMSFs as a way to fast track portfolios and bypass servicing requirements. Now, that's obviously a concern. We don't want brokers providing any kind of financial advice. And then also the risk that they were sort of saying of soft advice, where they might be telling their clients, hey, we can't offer this loan to you, but if you go and talk to your accountant and financial planner and ask them these questions, maybe you can get a loan to your SMSF and then you can come back to me and I'll write that loan. So kind of, again, self-serving, kind of pushing someone to do something that will end up in their benefit. Now, I think like some of these are obviously totally warranted. Like we don't want to see people offering unlicensed advice, but the broker associations, we reached out to them to be like, what do you think about these claims? Did you get the letter? They both confirmed they did. But both of them were a bit like, we'd like to see more detail. Like they were saying, what exactly are the problems that Piker is seeing that they're worried about from a broker perspective? Because we'd obviously then encourage our members not to be breaking the law. They already provide a lot of support on compliance and making sure their brokers are compliant. So I think they're a bit like, well, that's great, but we want to see more detail. We want to see a bit more engagement with this association to find out before they kind of publish this big open letter being like, what, you could have come to us quietly and we could have talked about this. But yeah, tough. We put it in the headlines. But I think that was kind of a really interesting one in terms of saying, because there's so much investor activity, some people are looking to get into that kind of area and attracts some of those investors, but potentially doing it the wrong way.
Yeah, I guess I don't want to say it's a grey area because I think in terms of from a regulatory standpoint, it should be black and white. But I think I always think it's interesting when you go on like a mortgage broker's website, how often the word advice comes up. Because
they can offer credit advice.
Yeah. Well, I think that's the distinction. But a lot of the time they just say broadly advice. Because if you wanted to buy a house, you wouldn't care about. You would just think, oh, it's a mortgage broker, you can tell me what to do.
Yeah.
But yeah, for brokers, obviously, there's quite a clear distinction that they need to be careful of.
Yeah. And again, like if you're buying stuff in like superannuation and SMSF lending, very highly regulated. You don't want to be messing with someone's retirement.
Yeah.
So I think that's again where the sort of the line crosses, to make sure you're just saying, if you need an SMSF loan, we can help you set that up, but you're not encouraging people to take one out. Some of the other things that we looked at this week also focus on compliance, and we'll get into those just after this message. So one of the other big stories this week was looking at what is happening with the compensation scheme of last resort, here are known as the CSLR, because that's a bit of a mouthful. Will, you were writing the story. So there's been a consultation going on over August. What was it about? Who said what?
Yep. So the consultation finished last week, and it basically was after feedback on how to address the situation if the total for the scheme exceeds the legislated cap. So it's a $20 million cap per year for the advice sector, and that was over by 47 million last year. So obviously massively exceeded it. And then there've been talks that there'd be a special levy to cover the cost. And then this consultation was essentially
how do we do that?
Exactly.
Yeah.
So FBAA and MFAA both submitted to the consultation. Essentially, they both strongly objected to the idea that brokers would cover the shortfall.
Yeah, because that was
cover the shortfall.
One of the three suggestions in this consultation, I think, that they kind of put forward. So the first one was, because we need to find $47 million somewhere, someone needs to pay this so that we can pay the people who are eligible for this compensation. They're saying either
67. Was it 47?
67, but 47 extra.
Sorry,
because of 20 million cap.
Yeah.
So they're saying either we can spread the compensation payment over several years, but that's not great, because obviously those who require compensation need that compensation sooner. We don't really want to wait years for them to get it. The second option, I think, was around just having the advice sector cover it, because they're saying they're the ones that caused it.
Yeah.
And then the third one is saying just having everyone who's under the compensation scheme last resort sort of share it. So sort of make it the responsibility of everybody, or at least everybody in that kind of area. So three not particularly great solutions here.
Yeah.
The first one obviously being because you're delaying the payment. The second one being because who on earth on the advice sector can find $47 million, like, just out of thin air, another extra thing they have to pay. And thirdly being like, well, why should, in this case for brokers, why should the broker industry have to pay for something that has nothing to do with them? What did the associations actually sort of say in their submissions?
Essentially, a lot of what you just said, that they've kind of lumped in different subsectors and put the cost on all of them equally. And they said that's unfair. The FBAA said they're treating brokers as a bottomless supply of money.
Or they would be if they chose
Or they
this.
would be, sorry, yeah. Peter White said that why should brokers be forced to pay towards the AFCA fees and higher scheme administration costs for shortcomings in another sector? MFAA, fairly similar, to be honest. They stress that the CSLR should act as a safety net and not a mechanism to shift costs onto other sectors. And essentially, it was they felt that it was unfair that brokers should foot the bill for something that wasn't. I mean, a lot of it, I guess, comes down to that cost blowout is due to financial advice failures or scandals, which is why it's so much higher than the previous year.
Yeah.
And they haven't differentiated with that in the special levy.
I mean, and this is also, again, why there's also another review generally into how the CSLR is funded, because this is likely going to be an ongoing problem. Like, if we're seeing the amount of stuff that's happening in the advice sector, they've had a hugely difficult and disruptive time over the last few years. Lots of companies have collapsed because of a range of different things. Lots of people have left the industry. So finding compensation for people is obviously important, but having a system that can afford to do that, there's so many regulatory costs already that people in the advice sector have. You've got the annual levy already for the CSLR, this special levy, which is coming down. You've also got ASIC levies, you've got AFCA levies, you've got professional insurance costs. There's so many costs already involved in actually being in this advice sector or in credit or financial advice. So it's kind of looking at, well, what happens if this happens every single year? If every year we've got $50 million over, where are we finding that money from?
That's the question.
It just doesn't make sense.
And the argument, you can spread it over years, but then
For how
we'd
long?
also have next year.
Yeah,
so we'd have to
exactly.
spread it again.
Exactly.
So it doesn't actually solve the problem.
It doesn't solve the problem. So, and some of the issues as well, I think in the advice sector, we're looking at what are we actually compensating? Because I think some of the things that were included in compensation include people just not getting the returns they thought they were going to get. So I think that's not actually an issue where it's sort of saying, you know, you're not in hardship. It's not like you've been missold something. It's just saying, I thought I was going to get 8%. I only got 4%. I'm going to claim compensation for that. So I think tightening the rules around what exactly people should be compensated for is important. So there are lots of consultations going on how the scheme works, because I think it's pretty clear at the moment it's not.
It's only been around for a couple of years, hasn't it? So I guess there's probably still tinkering with everything.
I think a lot of people just be like, get rid of it. We already have AFCA, like just get rid of it. But you know, we still want to see people getting compensation, particularly if a company has gone insolvent or is no longer around. Sort of not fair to be left out of pocket. But yes, if you've got any ideas on what you think the CSLR should be doing or how it should be structured, then you should let them know. I think the Treasury is doing that consultation, but the one on the special levy just closed. So that's the one we were talking about with the associations. And it's good to see them obviously taking an active stand against what they think would be really unfair. So they're very highly advocating to say, we don't want this spread across multiple industries, particularly ours. We think the advice sector should shoulder the bulk of it, considering that's where it came from. Just a couple of other things, talking about some of the regulators. ASIC released a corporate report this week, in which we saw some new focus areas. What are they looking at?
Yep. So this is their corporate report or corporate plan. And there wasn't a huge amount about mortgages, but they did specifically say that they were going to keep a close eye on offset accounts for mortgages. They mentioned essentially that customers were getting what they were promised by banks, and there have been a few high-profile issues over the last few years, and obviously they've shot up in popularity.
Yeah.
So they said they were going to keep a close eye. No mention of timing or penalties.
I know,
or
and I'm kind of a bit like, what exactly are you looking at? Because there's no detail in this corporate plan.
It was so light and detailed, yeah.
But they do, I mean, the corporate plan isn't really a sort of, it's not meant to be a detailed sort of overlook of their investigations, but it did mention generally what they're looking at. So offsets is one of them, making sure that people are actually getting what they're meant to be getting, that they're appropriate, that they're not sort of in any way losing out. But then also they mentioned the best interest duty compliance review as well, which we've written about before in the advisor. This is the first time we've actually seen them in print confirm that they're doing this. So I was like, oh, look, it is a real thing. Finally, someone said it. But yeah, so as we know, and as we've talked about previously, ASIC's been talking to the aggregators, being like, we want to see how brokers are sticking to the best interest duty, because it's the first time they're kind of reviewing it 5 years after introduction, to be like, how's it going? How's it tracking? What does it look like? And then maybe coming up with some best practice cases for it as well. And then finally, just summarizing again the sort of conclusion of lots of the compliance stuff. The big one that made news yesterday was about victims of the robo-debt scheme being awarded the largest ever class action settlement in history. So a further $475 million in compensation going to be paid to those in the class action against the government about the robo-debt scandal, which of course I think many people would have read or seen about in the news. There was a Royal Commission into it a few years back, looking at, well, what happened here. We know it was really a complete failure of the government in terms of looking at what they're providing to people in need. The Attorney General had actually described it as illegal and immoral. I don't want to go too far into all of the robo-debt scandals, because I'm sure many people know it, but just to sort of recap quickly, lots of people were very affected by this. Lots of vulnerable Australians who were receiving robo-debt were sent letters basically telling them to repay with interest things that they weren't actually meant to be repaying. So really getting into further trouble. In some cases, people falling into depression, and in some cases, really sadly, actually taking their own lives because of this pressure. So there's a huge amount of focus into this issue a few years back, and now an appeal has actually gone through the courts and said that the Commonwealth will have to pay $475 million in compensation to eligible members of the class action. And it would be the last ever settlement, as we said, in Australian history. So just looking at this, that would also mean that the government would have to look at legal costs as well. I think administrative cap administrative costs as well, covering the repayments of these unlawful debts. So really good to see that come to a head. Just to quote Attorney General Michelle Rowland, she said, "Today's settlement demonstrates the Albanese Labour government's ongoing commitment to addressing the harms caused to hundreds of thousands of vulnerable Australians by the former Liberal government's disastrous robo-debt scheme." She said it found that people were traumatised on the off chance they might owe money, and that robo-debt was a costly failure of public administration in both human and economic terms. Settling this claim is the just and fair thing to do. So that will now go through the actual sort of legal process, and I think that should be paid around the end of this year, so if approved. So looking at distributing that across the different group members over the next year or so. So big news there too. That's a lot of regulation stuff and compliance this week, I feel like.
Yeah, big week.
Yeah, big week. But next week we've got the SME Bootcamp starting up. So we're very excited about that. It will be going to Victoria and Queensland, New South Wales as well. So we've got 3 states over the next 2 weeks looking at hosting that. I think it's on Tuesday, Thursday, and then the following Thursday? Let me just double check those dates. So we'll be starting on Thursday next week, the 11th in Victoria, and then it will go to Queensland the following Tuesday, and then finishing in New South Wales here in Sydney on the 18th of September. So if you're interested in finding out a little bit more about how you can be writing commercial finance, how you can read business cash flows, this is a free to attend event. But it's very much a workshop. We give you tasks to do during the day. It's run in partnership with our friends over at Ascendo Finance, who are specialists in this area, pulling apart business cash flows, P&Ls, and understanding what can we be looking at to help our clients grow. How do we write business finance using these P&L statements and sort of, BAS statements, and then looking at how do lenders actually write commercial lending. So kind of really 101 into business finance. So if you're interested in doing that, it's open for accountants and brokers. It's free to attend. You can just need to register visiting smebootcamp.com.au. Also, if you haven't yet seen the photos back from the Australian Broking Awards, they're now up on the Momentum Media photo store. Premium members can get access to free photos as part of your membership. Otherwise, you can purchase photos if you want to frame them and put them on your wall with your trophy. You're welcome to do that. They're up there at the Momentum Media photo library now. So we hope you have a good old look at those and relive the highlights of the day. Will, Ben, thanks very much for joining me today. Any nice plans for the weekend?
Yeah, not too much. A Father's Day on Sunday. Course, yeah. So I'll be desperately scrounging around to get a present probably in the early hours of Sunday morning. Yeah. But that's about it. Yeah.
Will, how about you?
I want to get out on the bike. The weather looks good. So
yeah. Mountain or road bike?
Road bike. Borrowing a mate's road bike. So
nice.
You up to much?
Yeah. It's my birthday on Monday, so I'll actually be taking Monday off. But I've got I'm going on Saturday just to the pub with some friends, and then out for dinner. Yeah.
Perfect. Yeah.
Everyone else, we hope you have a fab weekend, and we'll catch you next week for another episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.